Welcome to this edition of IG Trading the Markets podcast, where we're looking at the second quarter earnings season in the States. While most companies have now, by and large, reported, at the time of this recording, we do still have some of the big retailers to come through with numbers. So let's take stock now with Chris Bailey, founder of the global investment research consultancy, Financial Orbit. Chris, it's good to talk to you. When we spoke just before the earnings release, you were then bracing yourself for some dire numbers potentially. How would you assess what we've been hearing from the second quarter from the US companies that have given us their earnings numbers?
Well, thanks very much for the talk again. It's very interesting. When we talked last time, we were anticipating a 40% fall in earnings on a year-on-year basis. What's actually come through, and you're right, there's a few numbers still to finish this earnings season off. What's come through is a 34% drop in earnings, which clearly is better than what people were expecting. So that's interesting. Nevertheless, we have had the biggest earnings and revenue decline on a year-on-year basis since the global financial crisis of 2009. So clearly it's still been a horrible earnings season. It's just not been quite as bad as what people were thinking.
Okay, let's take it apart to some degree, because we broke it down neatly into some interesting sectors, and you were then highlighting the fact that clearly the tech sector was going to be good. Let's start off, if we can, about what happened within tech. And I mean, we've seen record highs subsequent to the numbers for the NASDAQ and some of these companies that reported. So I guess it's been pretty good for the technology sector.
It has. It's interesting. If you look at all the sectors, actually the volatility after the earnings announcements was lower in every single sector apart from technology, where actually share price movements were even bigger than what investors were thinking or options markets were thinking before the earnings releases. So technology has certainly moved around in the period after earnings publications. Typically the numbers were good, and overall the technology sector, which is a very, very broad church, the technology sector had slightly positive earnings year on year, reflecting many things we talked about a month ago, the fact that they are maybe natural beneficiaries of the ever greater shift towards the digital economy and everything else. But the thing is, what struck me as interesting about the sector, and I think part of the reason why there was such a outsized, typically positive reaction to numbers, was that, of course, you had a very big exogenous event right in the middle of the earnings season, which was this quite amazing congressional committee meeting, which happened just before many of the biggest tech companies reported their numbers. And I think the juxtaposition of those two events, that actually led to greater volatility and ultimately a greater upside surprise and reaction by most of the big tech companies, which certainly kind of skewed the numbers just because of their sheer size and weight.
What about the banking sector? This was a sector, of course, that kicked it all off. The big banks reporting, I think, broadly speaking, a fairly good set of numbers, if you were certainly looking at those as an international bias. What was your takeaway from the banking sector?
Banks and the financials generally, they're always complex. We know that. If you've been kicking around the financial services industry for a while, you understand that the financial sector is complicated. However, this earnings round, the underlying numbers, you're right, were a little bit better than what people thought, in line with the broader trend of companies generally doing a little bit better than what people were thinking 4 or 5 weeks ago. However, what really blurred the numbers were the fact that there were very significant provisions taken, particularly by the banks, in anticipation of difficult trading, bad debts and related, due to the economic slowdown, the very rapid economic slowdown, the coronavirus crisis and all related. So it was a very confusing set of numbers, I would say. People are still unsure what to do with the sector. And you can see that by the fact that many of the even American banks are now trading at or around book value, something which you certainly wouldn't have seen over the last 2 or 3 years. So a very confusing, I think, earnings period, one where I think it's likely that going forward, there's going to be a lot of sort of specific opportunities, alpha picks and related in the sector, because there looks like the randomness in some of the the company's performances, it's going to be on the increase, I think, in this space.
Well, it's one of the things about the banking sector. They've been well prepared for another crisis. Of course, no one knew that COVID-19 was coming, and it was going to be that was the root of this particular downturn that we've seen. So that, to some degree, makes it very difficult to predict, of course, where all this is going to go. But the great financial crisis that we saw 10, 12 years ago, many are comparing, as you did at the top, about the earnings between now and what we saw 10, 11 years ago. But I wanted to ask, if I can, for some sort of idea as to where you think banks are going. Obviously, we don't know what's going to happen with COVID, but have they got enough provision set aside for bad loans, which it seemed to me to be one of the big things that's going to happen? We don't know how many jobs are going to go. We don't know how many businesses are going to go to the wall. Have banks set aside enough? Or have the authorities done enough, do you think, for the banking sector to prepare them for more catastrophic events to come? And are their balance sheets still resilient enough?
Yeah, it's actually one of the things which, when you listen to the conference calls or read through the transcripts of the bank management teams talking about the results in detail, most of them, and particularly this is true of JP Morgan, but it's true generally of most of the big banks in the States, they were all very much the view that they were extremely prudently positioned, that their knowledge and their insights from the global financial crisis of 10, 12 years ago meant that they were more rapid and quicker in applying significant provisions. And certainly, if you look at the aggregate provisions build up in the first couple of quarters of this year, it has been a lot quicker than that global financial crisis period of between approximately 2007 and 2009. However, they were also very critical of the US government, and the Federal Reserve, who have actually tried to make the banks step up and not pay dividends and have very conservative and cautious business plans. And all of the banks were saying, actually, the Federal Reserve have come in with an iron fist on this, and they think actually they've gone too far. So I think they would be very much the view that it's caution central in the banking system, and as a consequence, ultimately, they will prove to have been very prudently positioned. If that's true, and there are things like right backs to provisions and related, then banking sector investors will find opportunities from that.
Yeah. What about the oil sector? A big sector, of course, in the States, and there's a number of large global dominated companies in the sector. What about oil? What's been your takeaway from earnings we've seen from that particular area of the market?
Well, the energy space was expected to be the worst performing in terms of its earnings profile, and that's been the case. No great surprise with that. If you only need to look at the movements of the oil and gas prices, and of course, famously, we've had oil at negative points. And even that hasn't fully impacted yet because of the lagged nature of the way prices come through. It's clearly been a very, very messy and terrible earnings quarter for that space. So that was expected. Actually, reality was slightly worse in this area. And again, that's because of that mixture of not only difficult underlying operational conditions, but also the fact that a number of companies took the opportunity to write down their assets. Now, we've seen this in the London market for the big oil names. You had a number of the big American oil companies. Interesting, though, not ExxonMobil, but all the other ones, Chevron, et al., writing down some asset values because of the more difficult trading conditions. So that's led to messiness in terms of the numbers, generally missing expectations and being at the bottom of the tree. So in terms of sentiment, it can't really get any worse other than the oil price going on another absolutely a terrible run in terms of its shift. So I would say, standing here, the oil sector is very out of favour, an area which now has dwindled in terms of its weighting in the overall indices to a fraction of what, let's say, the technology sector is, or even the financial sector, which obviously is in marked contrast to its heyday in the 60s, 70s, 80s. So very interesting times. I would say it's a very much not just a play on the oil price, because many of these companies are very integrated, but also a play on sentiment. And if you see some stability in the earnings over the next couple of quarters, and certainly there's been a lot of cost cutting going on, a general theme in the market, very apparent in this sector as well, maybe there is a bounce back or a renaissance opportunity. Certainly very, very out of favour.
Okay, well, we'll wait on that. One of the sectors that benefits from a low oil price, of course, the airlines, but they've not been able to benefit because, by and large, they just haven't been trading. People aren't flying; they haven't been able to fly, and there doesn't seem really to be that much end in sight at the moment, especially as people are talking about a second wave of COVID-19, particularly in the States and around the world. We're seeing it in other areas as well. What are your thoughts about the airline sector? Are we getting to a point where people should now seriously look at this sector as a buying opportunity, or is it still too early?
It's fascinating. I'll give you a couple of stats first. I mean, we've talked about the fact that there on average was a 33 or 34% decline in earnings across the whole of the broader American markets this earnings season to date as we speak. However, the median company was only down around about 14, 15% year on year in terms of its earnings. And the reason there's that big skew is partly because of some of the sectors we've already talked about, things like energy and financials overhanging, but also areas such as the airlines, which essentially had losses, materially large losses during the quarter, because as you mentioned, they just haven't been flying, or if they have been, it's been at negligible levels. So what we've seen is very much cost cutting being at the core of the bounce back strategy, a focus on core routes, a focus on striking deals where they can with their employees, with the providers of their planes and related, in order to get down their variable cost base if they can. So very, very messy. And the shares, obviously, after we've seen some very high-profile defections and selling from the sector shares, people like Warren Buffett, for example, exited completely. We've actually seen a very volatile trading, and certainly, if you're looking for an area, I think the airlines and the cruise ship companies, with basically no earnings, massive losses, and in some cases, the need to have raised money over recent months. These are the areas where, if the companies survive, and it does look as if the biggest names will survive, just because at the moment they've got the support from the banks, and in some cases, as I say, have taken the caution of raising extra funds. They will be the areas which are most geared into a COVID-19 bounce back, i.e. where you don't get a second wave globally, you get consumer confidence starting to rebuild. But very much they're like a call option at the moment, and the shares of these companies have been trading like that. So extremely volatile, no earnings to go on. It's a purely technical sentiment play.
Yeah, closely aligned to this sector, of course, is travel and leisure, hotel groups, the cruise liners and so forth. Do we take the same sort of message that we've just been hearing from you for airlines? And can we lay that out in front of what we got for travel and leisure?
Broadly speaking, yes. I mean, the hotel groups, many of which have only reported in recent days as we speak, they tend to be a bit more asset light, mainly because they've had unbundling strategies over the last few years. And that means that they have a little bit more resilience. So certainly, yes, in terms of the direction, very, very geared, unsurprisingly, to improvements in sentiment and consumer willingness to travel and spend. But because they are a little bit more asset light, because they have a slightly different model, they're certainly much more likely to be survivors. And as a consequence, they're not quite as risky, full-on plays as some of the other areas, such as airlines and cruise ships, which are perhaps a little bit more in a slightly different position. So yes, similar sort of trends, not quite as risky, and you can see that in the respective share price moves of those different groups over the last few months, and certainly during the recent earnings season.
Let's just quickly move on to pharmaceuticals if we can, because this has been another really interesting area. And of course, unbeknown to us, as I said at the beginning of the year, that we were going to be faced with the crisis that we had to address. Of course, no one knew, because of that very fact, that farmers could well be one of the big gainers. And of course, those with businesses that are skewed towards the area of lung disease and breathing difficulties and that sort of control of a body's disease have done really well. What are your thoughts on the pharmaceutical sector? And are you still buying into this sector, or is this something do you think has gone as far as it can go?
Well, healthcare, broadly speaking, healthcare is one of the three sectors during this earnings season which have exhibited at an aggregate level some form of earnings increase, along with technology and the ultra-defensive utility sector. So healthcare, from a fundamental view, is benefiting from all the trends you touched on. Direct beneficiaries, in some cases, of COVID-19 trends and reactions, but also beneficiaries of longer-term trends, be it an aging population, or be it, particularly in the States, a system which certainly attempts to benefit companies with strong drug or treatment portfolios. So it has been defensive, and broadly speaking, it has performed as people would have hoped. The thing is, though, because there was less of an overt surprise in this space, unless there's been very clear news flow associated with, let's say, COVID-19 treatments, which clearly everyone is looking for, and obviously that's a little bit more focused on the biotech space, the bigger healthcare companies have had trouble in really surprising the market during this earnings season. Absolutely nothing wrong with their numbers. Progress has been good. Valuations are not excessive, but they're just very loved and very well owned. And so what you've tended to see is rather more lackluster reactions to numbers this time around, and a bit more excitement in some of the more biotech-focused plays, where perhaps there's more of a COVID-19 drug treatment or burgeoning drug treatment story, which people have jumped on. And obviously that's led to great volatility. But if there's been any progress in terms of the clinical trials, then that's generally still been positively jumped upon.
How do you feel now, sitting where we are in the middle of the year after having had the second quarter, about third quarter earnings as we look out from this point on?
Well, if we came into the quarter two earnings season expecting around about a 40% decline year on year, reality seems more like -33, -34%. If we start looking into the quarter three earnings season, then the expectation is for around about a 20% decline year on year, so compared to this time last year. And you would say that it's probably, given everything that we can see, the US economy struggling a little bit more with a sort of a slightly later first round of COVID infections and the disruptions that's causing, but also the fact that we've seen the dollar fall in recent weeks, and that tends to be a positive for particularly the multinationals in the US market. And the fact is that generally you expect earnings season to slightly beat, just because that's the way it is. Analysts are a little bit cautious going into it. I think that the story for the broader market is improving. I think this is a general global trend. What I would observe is that breadth is improving. I think this is important. It's a little bit linked with the lower dollar, but this time around, looking towards both quarter three and quarter four for 2020, I think there's less of a skew towards the earnings profile. There's a little bit less overt numerical love for technology and healthcare, and a bit more appreciation that there might be a little bit of value in some of the other areas of the market. Some of the sectors that we've talked about have been having a tough time, and even in things such as the consumer discretionary and staple areas, which obviously are wrapped up in consumer spending trends and related. So I'm expecting to see a broader US market in terms of the earnings seasons going forward. And actually that can only be healthy. Okay, maybe not what you want to hear if you've got a portfolio chock-a-block full of technology and healthcare or biotech stocks. But from a general health point of view, a broader market is typically a better market, a more sustainable market.
Okay, interesting advice. Thanks so much indeed for that, Chris. And it's interesting to hear what your thoughts are in terms of where we go from this point on. It's good to talk to you, Chris. Chris Bailey, founder of the global investment research consultancy Financial Orbit, joining us for today's IG Trading the Markets podcast. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.